This video is about the steps that banks are taking to prepare for the upcoming expected loan losses they will be taking because of the shutdown. How do these steps compare to the 2009 financial crisis, and will the effects on the housing market be worse than 2009? If you've been watching the stock market for the last few weeks, 4 weeks in particular, you may not think things are that bad. Here's a chart of the S&P 500 ETF, the SPY, and you see these last 4 weeks, this is a weekly chart, these last 4 weeks the market has retraced more than 50% its total loss from the top to the bottom ever since the Fed started buying back all these bonds in the market and propping up the bond market. So things are not looking so bad, right? These last 4 weeks. Well, let's look at some other 4 weeks over here. These 4 weeks are actually the weekly initial jobless claims. So while the market has been going up, the jobless claims have also been skyrocketing. And the historical average you see is down here. It's like 200,000. So how does this compare to other recessions? So we get an idea of what we can expect in terms of people not being able to pay their rent or their mortgages, and banks having big losses on their books from this. So check this out. All of these bubbles here are the peak initial jobless claims, a 4-week period for all the last recessions in modern times. And the 2009 recession, the peak was 2.6 million jobless claims in the 4-week period, and our unemployment rate peaked at 10% unemployed. Well, just in the last 4 weeks, our numbers are like 10 times higher than almost all of these previous recessions. And if you look at what the unemployment rate is right now, before the virus started hitting, the unemployment rate was about 4% out of about 164 million people in the workforce. Add this 22 million to that number. 22 million out of 164 million is about 13.5 million. Add the other 4% that we had before, and the unemployment number now in the US is about 17.5%. So the biggest unemployment number we've had in the modern era is in 1982 at 10.8%. Before that, 1933, during the Great Depression, the unemployment peaked at 24.9%. So we're not there yet, but we are way past this 10.8% here. So what does that mean for people being able to pay their mortgages or their rent? It means we're in uncharted territory that no person alive has ever experienced in the United States, this kind of unemployment rate and what effect it's going to have. And so why is the stock market going up? I don't know, but a lot of people liken it to a whole Wile E. Coyote moment. If you don't know, it's a cartoon where he would chase the roadrunner and he would accidentally go off the cliff, and he would stay in the air for a little while before he realized that he's not on ground anymore, and he falls down to the ground, of course. So it's kind of, we're kind of like in that territory right now where we are going off the cliff and we just don't realize how bad it is yet. Now, if the economy opens up, if we open up the economy back up quickly, maybe a lot of those unemployed people will be going back to work very soon, and Banks have these programs for forbearance and stuff where they add it onto your loan later on, some months later. So it's possible that a lot of these people may go back to work, but in the meantime, these banks are gearing up for some really bad things coming down the pike. So their preparations are kind of ominous on what they're expecting to happen. This article here on Zero Hedge shows the steps that JP Morgan is taking, and it seems that their expectations are for kind of a worst case scenario. So let's look at some of the steps they're taking here. For one, they just increased their loan loss provisions, and I'll talk about that later. But here they're talking about they don't accept any more applications for HELOCs, which are home equity lines of credit. And about a month ago, there were articles about all these companies that were drawing down their credit lines with banks to a record $124 billion of credit lines. And a credit line with a company is a little bit like a home equity line of credit. The money is there anytime they want it, and they all withdrew it pretty much at the same time because they're worried about what happened in 2009 when the banks withdrew their lines of credit before they can access some of them. So a lot of these companies are withdrawing their lines of credit now, and so JP Morgan is stopping with the home equity lines of credit because I guess the home equity lines of credit is a second lien on your mortgage, not the first lien. So they may be worried about not getting paid back on some of those if things get really bad in the housing market. They also halted all non-paycheck protection program loans. That's the program that they just came out for the small businesses, and they are backed by the government. So basically they're saying they're not lending to any of these small businesses unless it's a government guaranteed loan. So what does that say about their expectations? Not too good. Also, they're increasing the FICO score you need for mortgages to 700 and a down payment of 20%, up from a 620 FICO score you needed before and as little as 5% down payment before. So they're tightening their lending standards there. So it seems like they're really expecting bad things. And here it says that borrower requests to delay mortgage payments exploded by 1,896% in the second half of March. And this is just the beginning. And Moody's Analytics predicted that as much as 30% of homeowners, about 15 million households, could stop paying their mortgages if the U.S. economy remains closed through the summer or beyond. That may be pushing it, to say that it's going to be closed into the summer, but who knows? And Bloomberg calls this the biggest wave of delinquencies in history. And let's look at this chart. And so if the 30% number, like Moody's said, happens, that's about 8 times higher than where it is now, 3.77% to 30%. That's way off the charts. I mean, even in 2009, it only got to like 10%. So comparing some of these numbers now to the numbers from the financial crisis might give you an idea of how bad it could get for the banks and for the housing market if this shutdown goes on for a long time. So back to the loan provision loss for loan losses. What that means is that banks put money in reserve for potential loan losses that they think they're going to have in the future. And so looking here, that you see their loan loss provisions went up around starting 2007 because they saw the housing crash coming and people defaulting on mortgages. And it went up to about $8 billion here. And then it's been falling all over the last 10 years or so. to the point where it was under $2 billion in the beginning of 2020, and now it's up back to $8 billion. So let's see how some of these other banks increase their loan loss provisions. So here we have JP Morgan. This is first quarter 2019 in green and first quarter 2020 in red. So the difference year over year. JP Morgan from 1.5 billion to 8.3, that's more than 5 times. Citibank 2.2 to 7, that's 3 times. Bank of America 1.2 to 4.8, that's 4 times more. And Wells Fargo 1 to 4, or 4 times more. And to give you an idea of how bad things are compared to the 2009 financial crisis, let's look at the Empire State Manufacturing Survey, which is for New York State. Here the number has fallen to minus 78. So even during the financial crisis, the number was in the minus 30s or so. So this is way worse in terms of manufacturing compared to the financial crisis in 2009. So here are the loan loss reserves to total loans. So it's an indication of how much they have to put in reserve for upcoming losses compared to how many total loans they have outstanding. And you see right now the numbers are like no more than like 2.6% and as low as 1% of the total loans outstanding. Meaning if you have $100 of loans outstanding, you have anywhere from $1 to $2.60 of loan loss provisions in reserve. And during the financial crisis, it got as high as 6% for some banks like Citibank, and anywhere from about 3% to like 6%. So right now they are really low here. So if they are expecting it to be as bad as the financial crisis, then they're going to have to up their reserves by anywhere from 2 to 3 times more what they just upped their reserves to recently. And this number here, 2009, is with a 10% unemployment rate. Like I said, right now we're looking at 17.5% unemployment rate. So what are the loan losses going to be with 70% more people unemployed? Like I said, nobody knows. Nobody alive has seen this kind of unemployment rate in the US. If we open up the economy quickly, a lot of these people will go back to work and things may work themselves out. But you see these banks are really taking a lot of precautions because either they're overly cautious or they're expecting things to be a lot worse than what they're saying currently on the news and the financial channels. What does this all mean for the real estate market? Well, if we get things opened back up quickly and the unemployment rate falls quickly, then the forbearance programs may do their job in keeping people from having their houses foreclosed on. If the unemployment rate stays high even after opening everything back up, the forbearance programs will not stop foreclosures and they will lower housing prices because of that. Even if we went back to normal tomorrow and everybody went back to work, would you pay today what somebody was asking for a house before the shutdown? I wouldn't. And currently, mortgage applications are down about 24% from a year ago, and refinance applications are up 168% from a year ago. Unlike stocks that you can sell at the click of a mouse, housing takes a long time to reach a bottom. And from the time somebody stops paying a mortgage until the time a bank forecloses on a house and sells it again, it may take up to a year and a half or more. During the financial crisis, some people lived in their houses without paying a mortgage for 3 years or more. And I won't even get into commercial real estate like retail stores, malls, and even office space, because those sectors will most likely see declines no matter what happens, because many businesses will not reopen, and even many companies may keep a large portion of their workforce working from home to save on renting office space. If residential real estate falls a lot like in 2009, this may be time for many people to invest and get high rental yields going forward. I think there will be buying opportunities in real estate. You just have to be patient, do your research, and have the money on hand when the time is right. If you like this video, give me a thumbs up and let me know your opinion on what will happen to real estate prices if the economy opens back up very soon. If you haven't done so already, please subscribe to my channel. Thanks for watching.